Hey, happy Friday, options traders. Welcome back, everyone. And in the last video, I talked about how you can use options for a momentum type of strategy or for momentum traders, help you to stay more disciplined. Well, today I thought let's talk about the counterpart, what's called fading the market, and to show you how options can help you be more disciplined. So let's go take a closer look at fading the market. As always, before we do, please be sure to click like and subscribe. It's very much appreciated and helps so much to promote the channel. So quick review. Remember what momentum trading is. This is what a lot of traders use. And what it means is that you are going to buy shares as the price rises, but you are going to sell shares as the price falls. So let's say that you want to mimic this by just using shares of stock. Well, you could go out and buy a fixed number of shares, say 100 shares, and then you're going to buy a certain amount, let's say buy 10 shares each time the price rises a certain amount. So it could be every couple of bucks or so many percentage points. And so you just define these moments in time and you're going to add to the position, but only if the stock price rises. And then conversely, if the stock price falls, you'll do the opposite. Maybe you'll sell 10 shares each time the price falls a certain percentage or a certain dollar amount. And so the idea is pretty straightforward. You are going to buy on strength and sell on weakness. This is just a standard trend following type of strategy or momentum. Well, the counterpart to that is called fading the market. So obviously you're just going to do the opposite. So for example, you might sell shares as price rises and buy shares as price falls. So again, let's say that you buy 100 shares. You might sell 10 shares as the price rises a certain amount, again, a certain dollar amount or percentage, and you'll do the opposite if it falls. Maybe you're going to buy 10 shares as the price falls by a certain amount. So again, you're just doing the opposite. You are selling into the strength and you are buying into the weakness. Now, there's a lot of benefits in this because as we all know, when market prices fall, if everybody's trying to get out, what happens? Prices just plummet. And it can be very hard to get out at anything even reasonably close to what you think the market price is. It's just a big traffic jam of tons and tons of orders in there. However, if you're the buyer, you can place your orders well below even the bid and it's still probably going to get hit. So it becomes super easy to buy into the weakness, and of course, super easy to sell into the strength. When everybody's out there buying, they're looking for sellers. And so you can just do the opposite. You could probably place your sell orders even above the asking price, and a very good chance you're going to get filled. So that's one benefit of fading the market. But the basic idea is a little bit more of like a Warren Buffett approach. And one of his quotes is, "Be fearful when others are greedy, be greedy when others are fearful." And that's what he's talking about. When everybody else is selling, in other words, everybody else is fearful, that's when you should be greedy and you should be buying. But when everybody is showing this irrational exuberance and going on these massive buying sprees, that's when you should start tapping the brakes and being a little more cautious or be a little more fearful. So what's an option strategy? Or how could options in general just help you with this idea of fading the market? Well, there's actually lots of them. And again, we're going to put gamma into our corner. Now, for the momentum traders, we looked at using positive gamma. And so here we're just going to do the opposite. We're going to look at negative gamma. So one kind of a simple strategy might be to buy, let's say, 100 shares, but sell a straddle. Now, a straddle, recall, is a strategy where you have a call and a put with the same strike and the same expiration. So if you buy that combination, you would be long the straddle. We're just going to sell it. We're going to sell a call and a put with the same strike and the same expiration. And what's that going to do for us? Well, let's go have a look. So for example, let's say that you buy 100 shares, or maybe you've already got 100 shares in the account. What you could do is to sell a straddle. So for example, let's say that you sell the 105 put, let's make a price of 3, you sell the 105 call, we'll also say it's trading for 3. So now you're selling the call and the put, same expiration, and the same strike. So it's selling a straddle. And what's that going to do for you? You're long 100 shares, you sell one straddle. Well, your risk graph looks like this. So this is our expiration graph. Remember, we get a bend at the strike, so there's our 105 call and put causing that bend. This is the expiration graph. This is what our profits and losses look like at expiration. But today, they're going to look something like this. And you can now see a little clearer this fading effect. As the stock price goes up, look what's happening. This gray curve is starting to taper off, starting to go towards zero. But if the stock price falls out this way, what happens? See, now we're heading towards this end of the curve. We're starting to go from a flat curve to a very steep curve. Now you might look at this and say, well, wait a minute, this looks like a covered call. Well, sort of, but you're long 100 shares, and by selling the straddle, you've now potentially increased it to 200 shares. Because by being short that put, if the price falls, if the stock price falls, you're going to get assigned, and remember that gives you the obligation to buy shares, that short put. And so if the stock price falls, you will get assigned, you will buy the 100 shares, which will now give you 200 shares. So the strategy is forcing you to buy as market prices fall. So the reason that this isn't quite like a covered call, at least in the sense that you're probably thinking of it, if you had your 100 shares and sold a call, you would look like this instead. And now you can see we have 100 deltas right here. We're not quite as steep as we are on the black line. That's from this short put that's out there. So see, if you just had 100 shares and sold the 105 call, you didn't sell the straddle, you just sold the call, yes, it will have a similar shape to this risk graph. But you've only got 100 deltas down here. That's from the 100 shares you've already got in the account. But if you have 100 shares and you sell the straddle and you get assigned, you could have 200 shares or 200 deltas down here. So that's the difference when you sell that straddle. You're sharply increasing your deltas down here, which is exactly what you want if you are fading the market. But in both cases, look what happens as the stock price rises. You're going towards zero. That's why this black curve and the red go flat. As that stock price rises really anywhere above that strike at expiration, you're going to get assigned on that short call, part of that short straddle, and you will sell your 100 shares. Same thing with just if you had 100 shares and sold a call, you're going to sell those shares. So in both cases, you have 0 shares if the stock price rises. But isn't that what you want? Notice even with the covered call, you're going from 100, stock price is rising, you're going towards 0. You are fading the market. Or as the stock price falls, you're going from 0 towards 100. You're fading. So in a sense, you could say that a standard covered call is a way to fade the market. But this is a way that's perhaps a little bit more in line with that by buying the shares and selling the straddle, because you're actually increasing those potential deltas. So you're going from, let's say, 200 shares towards 0, or if the stock price falls, you're going from 0 towards 200. You are fading the market. And the thing that's nice about this is it really keeps you on track. It keeps you disciplined. It's really easy when those shares are going up. You started out thinking you were going to fade the market. You've got this game plan. And then what happens? You know what? Let me hold on and see what happens. You're going to want to change your plans. You're going to want to start gambling a little bit more and hope that you get even more profits. And then if it falls, what happens? Instead of buying, you're going to say, it's too risky now. The market's falling too quickly. I don't want to buy. It makes it very difficult to stick with your plan. But again, here's a very simple strategy that can force you to stay on track and to help you stay more disciplined. So I thought that might be just an easy way to show you the idea of how options can help you make better decisions, better choices, and keep you on track and more disciplined with your trading. And that's just by buying shares and selling a straddle. So the main thing is, remember that options give you choices. And the more strategies you know, the more choices you have. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.